Welcome back, everyone, to Lam's Cryptoverse. So today, what I want to talk about, and the main gist of the story, is lending standards. But before we get there, I want you to have a feel for what's going on with the economy and what's going on with the Fed funds rate, basically. Just those two things, and then we're going to dig deeper. So let's get started. So I'm going to minimize myself a bit here. So the first thing I want to talk about is the probability. I think you've all seen this. This is from the CME group. And I was going to say each quarter, but each day they have a probability of what the target rate's going to be from the Federal Reserve. So right now, the current target, I call it 5%. It's actually 4.75 to 5%. And they don't list it as that. Here's my pointer. They call it like 475 to 500 bips. So that's basically basis points. And if you look here on the left side, there's a 51.6%, basically 52% chance that rates are not going to go up during the next Fed meeting. And the next Fed meeting is right here. If you look at my pointer, May 3rd. And if you look at the right side, this is for quarter point rates. I always look at the highest number. So the highest number here is 500. That's the current target rate. And the highest number here on the bottom right is 525. So the odds are, as of today, that rates are going to be flat. I still think Fed's Jerome Powell, is going to think about raising. It depends about what's going on with the savings crisis. I mean, the deposit crisis, basically at banks. So obviously that's the big problem. So, but I'm thinking May 3rd is a long time from now. And if you saw my video down there on Silicon Valley Bank Group, I actually said from the get-go, before the bank even went shut down, I said, I think it was a Thursday night or Friday, I said, before the shutdown, I said that this is going to be like the March moment when New Century went bankrupt. Everyone forgot New Century. Then there was news on Bear Stearns. This is going back to, like I said, 2007. People forgot about that. Market went up. Then BNP on August, I can't remember the date, August 15th of 2007, said they couldn't price their mutual funds because they couldn't get mark-to-market data, like real-time data on all this junk CDOs, right? So what did the market do after that? Well, the market, meaning the Dow Jones, actually hit a new high by October. So it shows you that crises take a long time to play out, and they could seem like they're huge and big and then just disappear and people forget about them. That's just how things work. So let's go back to here. So the CME probability is that there's no increase in Fed funds rate. I'm saying it's too early. Next table. This is what Jerome Powell has been talking about. Like he like creates words, like no one knew about the dot plot. Then he started talking about the dot plot. No one knew about the natural inflation rate. Then he started talking about that. And no one knew about the terminal rate. I never heard of a terminal rate, but that's what everyone's talking about now. So here, I want to make one or 2 points. This dot plot, these are the FOMC committee members. And this is what they're voting on, or what they're assessing, what they think rates are going to be, like us, 2023, 2024, 2025. So 1 or 2 points is, first of all, the one in the blue, that's the median projection, the blue dots. And so you're going to notice that they go down from 2023 to 2024, and then 2025. So that's the first thing to note. The second thing to note is that even though theoretically, this Federal Reserve is supposed to be speaking as one voice, but it doesn't. And even if all the FOMC members, if all the Federal Open Market Committee members are against Jay Powell, it doesn't mean rates going to move in that direction. So I think that the dot plot might be indicating a quicker decline than may actually occur because Jerome Powell was very, very adamant about keeping rates high until inflation goes down to 2%. When he says that, he doesn't mean the higher inflation number that people are looking at, meaning the CPI number, Consumer Price Index. What he's looking at is a PCE, the Personal Consumer Expenditures Index, which is about 1% lower, I believe, than the CPI. So let's go to the last chart from CME. So this is probably something you haven't seen. This is the meeting probabilities. This is what people think, not the FOMC. This is what investors think that the Fed funds rate will be at these specific dates here, as you can see in the row. So if I've highlighted, I'm going to highlight the next meeting. That's on, we're in 2023. That's on May 3rd. And if you look across, so I'm trying to understand this as I'm speaking to you. So if you look across all the way to the right, you can see there's a 60% chance of a 500 point rate in Fed funds and a 40% chance of 525, meaning you raise. Now, we talked about this already. This comes from, or is similar to this chart I just showed you, this one here, actually. It's mimicking this, and this doesn't really do it justice. So what you got to do is go here, and this is looking at all the meetings, basically. So it's looking at the federal funds futures. And what it does is it calculates what the rate would be based on these futures. So you can see the prices here, 95, maybe they go up to 96. That's the key thing to look at. So remember, as the price goes down, that indicates that the interest rate goes up. That's just how bonds work. Even though this is not a bond, right? The Fed funds futures, for people that don't know, I should say the federal funds rate. I even thought the Fed funds rate was a short-term rate, like 3 months, but it's not. It's actually an overnight rate, and people forget about that. And why do people like me forget about that? Because people always say, the analysts out there say that the 2-year Treasury yield is reflective of the Fed funds rate. And I'm thinking, why would people look at the 2-year Treasury rate when it's 2 years greater than the overnight Fed funds rate? Well, it has to do with lag and timing. It takes the Fed at least a year to raise rates. So that process gives you that duration of 1 year. Then you add another year duration for the effect of each raising of the Fed funds rate. So in other words, when the Fed raises rates by whatever it is, 25 basis points, the economy does not feel and is not affected by that rate increase until a year later. That's why economists and hedge fund guys, they focus on the 2-year Treasury note, and they focus on this too. So what I wanted to show you from here, besides all that stuff I blabbed about, is if you look at the blue cells, this is where the highest probabilities are. If you notice, there's a diagonal, like we start here, right, and we go lower and lower, and something happens here. In September, the probabilities of a lower rate, and that's strange because the Fed's been raising rates since March of 2022. So what's going on here is investors are signifying a Fed pivot. In fact, they're signifying that by July 31st, the rates are going to go down all the way to 3.5%, or even lower, 3.25%. And that's signified by the 325 to 350 basis points on the Fed funds rate. And you can imagine if the Fed funds rate is at this low level, other rates are going to be lower because this is going to carry through, not 100%, but it's going to carry through into the yield curve. And the yield curve, as you know, starts at basically 0 and it goes up to, what is it? It might be 3 months, and it goes up to 30 years. So let's look at some economic data. This is going to be mostly macroeconomic data. So this is from the St. Louis Fed, also called Fred. And here we've got gross domestic product growth. And you can see that the economy is still quite strong. We haven't even gotten negative yet. And this is real. These are real rates. I'm sorry, this is real economic growth. It's actually even higher if you look at it from a nominal point of view. So just keep that in mind. I'm just trying to fix this here. And this is going out to 2025. So that's the first thing we know is that the economy is not in a recession. I can say that with all confidence. 2, unemployment rate. Unemployment rate, it was unbelievably strong. I think we're at 3.6% as of February, which is unbelievable. I'm saying it again. It's just so strong. And it's historically very strong. I mean, I could go back. If you like, I could hit max. Let's hit max and see what it goes back. It goes all the way back to 1970. And look at that. You're talking about historically extremely low levels. And this is why we have inflation. Next chart. Okay, this is what I mentioned to you earlier. This is what the Fed looks at. Now the Fed's talking about other types of inflation because they were criticized for being so dependent on lagged inflation data. But basically the one they like to look at still is the PCE. And this has come off from the high, just like the CPI, but it's a bit lower than the CPI typically. So there you go, 5.38 in January and 4.71 for the core rate, I should say. For January. So these are fairly low rates, meaning they're coming down quite quickly. And I didn't show you true inflation, but true inflation also shows that inflation's coming down quickly. Maybe I should just open it real time if you just bear with me. If you just bear with me, I could probably open it in a few seconds since my internet's working pretty well. So here we go. So I like to look at this because this is like an independent source of inflation. And here you can see it's gone down dramatically from 12% in mid-2022 down to today's 4%. It's unbelievably low. And I mean, coming down unbelievably fast, I should say. And that's due to, I believe it's transportation that's going down quickly. So that's transportation. You can see it right there. So let's get back to where we were on macro data. So the PCE inflation is coming down, but remember what I said. The Fed's not going to stop raising rates, or at least holding them, until it comes down to about 2% here. And that's the low range here, 2025. And remember, historical data says that when inflation, and this is CPI inflation, when the CPI inflation breaches 6%, usually it takes 4 years to go back down to 2. So this kind of makes sense here. That's going to take a while. Here we talked about it already. The Fed funds rate looks like it's going to be peaking in the fourth quarter of this year. And some people say maybe early. I'm not sure what this data is from. Projection from the latest SEP. The sessions are shaded. Board of Governors. So this is from probably the FOMC data. And that was that. So the next one I want to show, and this is what I want to concentrate today. It's on this. The net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. So I know that's a lot to swallow. So I'm going to talk about in baby steps what we're looking at here. We're just looking at how strict banks are in terms of lending. And the commercial industrial loans, all that means is basically loans to corporations, like loans to General Motors and loans to Tesla. That's all it is. And so this is like basically the one we should focus on. And so there you have it. So what I want to talk to you today is that I'm predicting, I don't even think we should look at this, by the way. The 2020 was like almost like a blip. If you were to eliminate that, you can see we're the highest since 2000, the 2008 financial crisis, which was a banking crisis. Remember that. That's a crazy thing here is that lending standards have already gone up tremendously. Now, this is based on a survey. It's a huge survey. I'm going to show you in a moment. It's like I said, it's a huge survey that and that sent a survey to, let me think, to 80 large banks and 20. I'm sorry, 80 large domestic banks and 20 uh, like subsidiaries of large commercial banks from overseas commercial banks like Deutsche Bank and Societe Generale. But my point is 2 points. Number one, it's the highest, like I said, since the GFC. Number two, and here's where it gets really scary. This was conducted during the fourth quarter of 2022. This is before the Silicon Valley Bank, SVB, shut down, before the Signature Bank shut down, and Silvergate Capital, and the problems going on with First Republic. This is insane. So what I want to tell you is that the next survey, which comes out, doesn't come out for a while. I believe it's a few weeks. This survey is going to me. It's going to it's probably going to hit a record high. It may hit a higher number than was hit on Q4 of 2008, believe it or not, during the Lehman crisis. If not, if I'm wrong, I'm not off by much. I think we're going to be here to the second quarter or third quarter of 2008. And then if things get really bad, which I think they will, it's going to definitely hit a record high. So that's what I'm worried about. So if you're worried about smaller banks, since that's what's in the news, I pulled up this same survey for small banks. So let's take a look at it. And as you can see, it's the same damn thing. So we really don't need this. So I'm gonna switch back and forth. You know what I mean? You're gonna know what I mean because this chart looks the same. You see that? So you don't really need to look at this, but just in the interest of being fair, I want to show you that this here is the survey of lending standards for small firms, loans to small firms. It's right there. And then if you look at small banks, it's the same thing. These charts all look the same, whether it's a large bank, small banks, regional banks, whether it's loans to large firms, small firms, whether or not you include in a consumer, it's all the same. So I think we're going to get close to hitting a record high in terms of banks tightening their standards. And when that happens, then and only then you're probably going to get some kind of recession because we need to have a tipping point. And we haven't had that tipping point yet. I think that's going to come from a weak commercial real estate market. If you look at vacancy rates, we're about 18% right now. That's insane. And if you go to places like Manhattan or San Francisco, it may be worse. And those are major cities that are benchmarks for this. I'm losing my voice, excuse me. So we talked about lending standards. Let's talk about this. This is the actual survey. It's a huge survey. And I'm not going to go over it with you. I just went over one or two charts. What I do want to show you is if you weren't sure where we were going with that survey, like with the last survey, and I said the future survey is going to be stricter. Let's say you weren't sure and you didn't believe me. Well, they were asking special questions during the last survey. You could read it. It says questions 37 to 40. They're talking about expectations for loan delinquencies and charge-offs in C&I, commercial industrial loans, commercial real estate, and consumer loans. And if you look at all these, and this goes on for pages and pages, I went forward too much, but basically this is an outlook for all of 2023. And if you look at all of these pages, and like I said, it goes on and on. So you look at this one. Compared to my bank's current lending standards over 2023, my bank expects lending standards for approving applications to small firms will be what? and it says tighten somewhat. You see that everywhere. All the answers are the same. For 2023, for whether it's large firms or whether it's small firms, large banks, small banks, it's all the same. Lending standards are getting tighter. So there you have it. Now, what I want to show you is how this banking crisis began, or one catalyst or trigger for the banking crisis. I have to be honest with you, there were a few triggers. It wasn't just one, especially for Silicon Valley Bank. It was, VC portfolio companies, they needed money perhaps. Maybe they had lower deposits because they needed the money themselves. But most of the reason why Silicon Valley had a problem to begin with was that deposits were declining. So here we have deposits from small domestic banks. And you could see this is a year-over-year change. You could see this is the biggest decline. So we were all the way up here. We had a crazy 24% increase, 24% increase in deposits as of 2021. We went from 24% down to a minus 1.5% decline. That is the largest change in history. And the largest decline goes back to the mid 80s when the banks had the same problem, which is, there was a savings and loan crisis. Why? Because interest rates went up, right? It was the same thing. The yield curve inverted, short-term interest rates went up, and so banks could not make money. Not only could they not make money in their loans because they borrow short-term and lend long-term, and the long-term rates that they were lending at were lower, so the net interest margin was lower. Not only was there that problem, but they were losing money on their investments because when they invested in treasuries, those treasuries went down in price depending on whether they were one-year treasuries or two-year treasuries. They basically lost money. So that's what's going on here. Silicon Valley Bank, for example, they had a pretty specialized portfolio, right? Venture capital, maybe throwing some crypto in there. Then you've got the venture capital portfolio companies in there. And these are very techie-oriented funds. And then you have wealthy people too. And these people, they weren't getting high rates on their deposits. They were getting close to zero. So they started pulling out. So that's one reason. I said other reasons too. Maybe some of these crypto companies or VC portfolio companies were burning money so that their deposits went down. But either way, the point is that deposits went down. And if you look at deposits for large banks, you see the same trend. Nothing's changed. So I presented to you why lending standards are going to get worse. They're going to get stricter. And I showed you a few reasons why I think they could get stricter. I showed you some charts. I showed you some macroeconomic data. I showed you deposits going down, which is going to scare to death banks because they feel like they have no money, even though the Fed is a lender of last resort, and they're lending via the discount window as well as the new TARP plan. I forgot the name of it. It's a new acronym. But even though I showed you all that evidence that lending standards are going to decline, what I did is I went to Google's new board. This is ChatGPT's linguistic competitor. So I was asking Bard, tell me your expectations for the next Federal Reserve Lending and Loan Survey. And here's the answer from ChatGPT, from Bard. Bard said, I expect the Lending and Loan Survey will show that lending standards and terms have tightened further as banks become more cautious about lending. I also expect that demand for loans will continue to weaken as businesses become more cautious on spending. And then it says, finally, I expect that banks' expectations for the economy will continue to be negative and that they expect the economy to slow down. So there you have it, friends. That's from AI, artificial intelligence, from Bard. So if you didn't believe it from me, take it from Bard. So there you have it. So I hope you enjoyed this. If you like it, please hit the like button down there and subscribe.